It's the beginning of a new era at Nike. On Monday, longtime Nike veteran Elliot Hill took over as president and CEO, officially grabbing the reins from the now former CEO, John Donahoe, who drove the company into the ground in what can only be considered a new land speed record, sadly. So with the company finally under new management, what's it going to take for Nike to make a real comeback? While the stock's already rebounded substantially off its August lows, in part because of this leadership transition, the turnarounds, they take a lot of time. Plus, Elliot Hill has been dealt a very poor hand. When Nike reported a little over 2 weeks ago, it delivered a solid earnings beat, but it also had a revenue miss and weak guidance for the current quarter. They even pulled their forecast for the 2025 fiscal year, which ends in May. The stock got dinged in response. It's still down more than 50% since it peaked in late 2021. Business is not good at Nike. So how can the new CEO turn the ship around? The company's already taken the first step by firing John Donahoe, a great tech executive who turned out to be a suboptimal shoe dog, the name real shoe people identify with. They replaced him with a homegrown Nike guy, someone who got his start there as a sales intern in 1988. Before his retirement in 2020, Hill served as president of consumer and marketplace for Nike. He really knows the core business back to front. You need to know that Hill is beloved at the company. Employees actually cheered the news of his appointment last month, and he reportedly got a standing ovation at an all-hands event on Monday. That matters. Morale has really suffered under Donahoe. But I also like that Hill's not in denial about the very real challenges that Nike faces, even as he seems confident that he can turn things around. The last guy always seemed clueless about what was going wrong. It was almost as if he thought that it was going right when it was going wrong. And make no mistake, there's a lot wrong here. Nike got too reliant on direct-to-consumer DTC channels, especially their digital marketplaces. The consumer's grown more tepid in North America and Europe. China's awful. At the same time, Nike's facing intense competition, especially in their core footwear business. Competition from Cramer faves like Hoka, part of Decker's on Outdoor, and on Hold It. And even old-timers like New Balance, Asics. So how can Hill turn things around? I got a couple suggestions. First, Nike needs to repair its relationship with top distributor partners like Foot Locker, where they used to debut some of their best new shoes before moving many of those hot launches online, mistakenly. Same goes for Dick's Sporting Goods, one of the few scaled players remaining in the sporting goods retailer space after Sports Authority and Modell's went under. Fortunately, it seems like management's already on the case. Listen to what Foot Locker CEO Mary Dillon told us just over a month ago. I think it's important for people to know that you have solidified the relationship with Nike to the point where you're getting the absolute best. Some felt that Foot Locker wasn't getting that. This, to me, is really the most important stuff that Nike has to offer.
Well, listen, I'm excited about where we're heading with all of our brand partners, and Nike and Jordan brand very important to us. You can see many of the launches here. In fact, we have some new Kobe's up there on the shelf. And, for us, it's about really building together with all of our brand partners to drive category growth.
Nike started fixing its retailer problem back in July when the company brought back another retired executive, Tom Petty, to manage its retail relationships. Like Hill, he left in 2020 when the Donahoe era began. News of his rehire broke in July. I'm bringing this up now because in the week since we learned that Elliot Hill's taken over as CEO, we found out that Petty's getting an even more important job, general manager of North America, effective October 21. So clearly Nike's on the case here. The next problem for Nike is the spotty consumer spending environment, both at home and abroad. This is something they have zero control over, but with central banks around the world cutting interest rates in order to juice their economies, I think we're headed in the right direction. Just today, the European Central Bank cut rates for the third time this year. That's pretty big. All else equal, these moves are good for the consumer, especially the kind of consumer who might be willing to pay a premium price for a pair of sneakers. The next piece of the puzzle, China, which looked pretty bleak until a few weeks ago. But now that the Communist Party's announced their largest stimulus effort in years, including programs aimed directly at consumers, things look, let's say, a little less bleak. Very helpful for Nike, which remains in very good stead with the communist regime. Hey, who doesn't love Michael Jordan? So far, so good. What I am worried about, though, is competition, because those challengers like Hoka and On have become a lot stronger in recent years, and they're also much better in quality than they used to be. I certainly don't think the Nike brand is dead, but it's been losing mind share. In the latest iteration of the semi-annual Piper Sandler Teen Survey, very useful poll of thousands of teens, Nike had what I can only call mixed results. But look, it held on the #1 spot as favorite brand in footwear and apparel for all teens, and it's still #1 by a wide margin. That's very good for Nike. It's why I wouldn't write it off. But a year ago, 61% of the teams called it their favorite footwear brand. That's down to 57 in the latest survey. Because of some quality concerns that a lot of people have and a lack of newness, I think the downward mindshare trajectory is going to continue. Look, the Donahoe era did real damage to Nike. The quality of the company's products, once unassailable, is now perceived to be notably weaker. Remember, Donahoe was a tech guy, not a shoe guy. He focused too much on aggressively growing the digital business with great technology and not enough on the actual merchandise. something that doesn't fly if you want to try on the shoes. And who buys expensive shoes without trying them on? I believe the new management team led by Elliot Hill can fix this. They're shoe guys. But I'd like to see at least a little more evidence before declaring that the turnaround is at hand. Unfortunately, sometimes in this business, you can't afford to wait for decisive proof. Nike's already selling for 30 times this year's earnings estimates, which is far from cheap, but still a nice discount from its 5-year average multiple. It's just, if just a couple of things go right here, the stock can roar. If you're waiting for a proof of comeback, you may just miss the bottom. So here's the bottom line. Nike's under new management. It's once again being run by people who understand the footwear and apparel business. And we've also got central banks around the world cutting rates to make things easier on the consumer. At this point, you got my blessing to put on a small position, only small. Because if Nike really can turn itself around, the stock will take off long before the financials do. You need to get ahead of that. But it's a risky call, so I should just build your position gradually over time. There's no hurry to buy this one because the fix can't be a quick one. Too much damage, too much mind share sacrifice on the digital altar by the Donahoe regime. Mad Money is back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.